Thank you. One of the points that Dr. Kono made is that the Fed tries to accommodate the public's demand for money.
Right.
And I guess I would argue that particularly in the subprime loan crisis, that it was made worse by the Fed creating interest rates below the market rate. So in a real economy where the interest rates, because they're set by a vote, I mean, we don't set the price of bread by a vote. This isn't a real good, real market pricing system. A bunch of old guys at the Fed vote on what the price of money should be. But in a real economy that has freely floating interest rates, if you have a housing boom and everybody wants to borrow money, you have increased demand for the money. The response would be the interest rates would rise. But you had a period of time from like 2000 to 2007 where you got interest rates at like 2, which is essentially 0. If you got inflation of 2 or 3 and you got interest rates of 2, your real interest rate's like 0. That's not a real interest rate. And I don't think the market would do that. As you have this housing boom, interest rates would have risen. And so the cycle of the economy is incredibly dependent on interest rates to tamponade the effect of the boom. So as you get a boom, as interest rates go up, only the better projects, the ones more likely to succeed, will happen. And if I'm borrowing something with no capital, it's less likely that I'm falling away as interest rates go up. But if you don't allow that, you're part of what creates the boom. The Federal Reserve was responsible in some way for the boom by keeping interest rates below the market rate. I'm not going to start with you, but I'll come back to you. Let's start with Dr. Michelle. What do you think of what I've said?
Well, it definitely has an effect on rates. It's probably not positive in the sense that it's not a good outcome. But I also think it's very important that we don't divorce what the Fed's doing in that regard from what the rest of the federal government is doing. The Fed didn't decide to create TARP. So there's a lot of money floating around, and any of the money that they did provide for liquidity could have been provided through Congress, and a lot of it was done in both places. So I think it's hard to separate out.
The low interest rates leading up to it also have a reason. I think they may say they want to help the economy, but they're really trying to keep the financing of a $38 trillion debt manageable. So that's a big reason for why we do it. We'll get
also combined, yes.
Yeah.
Yes.
Ryan.
Yeah, it's a question of trade-offs. If you lower interest rates, yes, you lower the price of government debt, and that can be very important for the federal government's fiscal health. But the trade-off of that is higher inflation for the rest of us. So you can choose one policy or the other, but you can't choose both because there will always be a trade-off.
Mr. Westbury.
Yeah, and bubbles as well. I mean, Brian, you're absolutely right. The interesting thing today is pre-2008, we had a scarce reserve system, and banks traded reserves every single day. There was a marketplace. Once we have made abundant reserves, nobody trades federal funds. There is no market rate anymore. And that rate now is, Dr. Paul, you're absolutely right. It's set. They sit around a table and they go, what do you think? 3 1/4, 3 1/2, 3?
But I guess my response to that is between 2000 and 2007, we were still doing, as you say, having this daily marketplace. Right. I would still argue that from 2000 to 2007, that the interest rates were at the direction of the Fed below the market.
Well, I agree, because they were adding reserves that they shouldn't have added. And so it can happen under either system. Right. It can totally happen. But today, there is no market input at all. That's what I would argue, that the Fed cannot see the demand for money. They used, when the rate would want to go up under the old system, that was a demand for money. Today, there is no sign of demand for money like that.
I think we've got a pretty good focusing of this debate. Is this debate going on outside this room? I mean, to a large extent?
I wish it was going on more. One of the things I will say is that you and your staff study, which is fantastic, for the first time that I know of, forced Chairman Powell to address the ample, abundant reserve issues in a speech, because the Federal Reserve has kind of ignored it, acted as if it doesn't really exist, and the press doesn't ask questions. So thank you for pushing this.
And I think the point that we've gotten to is a better and more important point about whether the Treasury loses money, the profit loss of the Fed. We're talking about whether or not the interest rates are being set by a daily marketplace versus a long-term thing, which seems to be more of a decision by fiat, a decision by a bunch of let's just call them grumpy old men around the table.
I call it
But
price fixing.
I don't think there's any difference between the way rates basically were set before 2008, and I was part of this back into the 1970s when I joined the Federal Reserve. Every day we had a call with the Federal Reserve Bank in New York, and we decided, the Federal Reserve Bank in New York and the board staff decided how much money they needed to put in or take out in order to fix the interest rate, right? So the mechanism was a little different under scarce reserves, but the control of the federal funds rate, of the short-term interest rates, the repo rates, were just as strict before 2008 as after 2008.
And I would argue that one of the things that brought down the Soviet Union is that nobody knew the correct price of bread. Because the marketplace doesn't work, because nobody does. I said it here, and then I got bread rotting on the shelves. I said it too low, all the bread's gone. The only thing that can figure out, and this is the miracle of capitalism, is that supply and demand, and as Senator Josh said, millions and billions of people trading instantaneously leads to just this incredible knowledge that no one possesses.
Right.
It was this whole idea that Hayek talked about,
to
the
be-
conceit, the conceit of a bunch of 10 really smart men. And I'm not begrudging the people at Fed not being smart. They probably are very smart, but they're not as smart as a million people in the marketplace. So what we should try to do is have as little impact from the Fed on what interest rates are and figure out a way, if there is a transition to a more market-oriented, where most of the interest rate is determined by the market. Because I think between 2000 and 2007, under the old system, they were manipulating. I think it caused the subprime crisis. I agree, mark-to-market probably exponentially made the subprime crisis work, but it got started with the subprime crisis, which I think was directly related to interest rates being, lower than what the market would have dictate.
So, I mean, the market controls every interest rate beyond the overnight interest rate. So if the market thought what the Fed was doing was, right now, lowering rates was inflationary, you would see it in the bond market, and you don't
But then they
see
also
it.
control the money supply. So don't you think the money supply has something to do with interest rates also?
I think it's the amount of money, the M2 money supply is the amount of money people want to hold at the current interest rate.
And
Yes.
I would argue the Fed influences interest rates out the yield curve too, and that's what the whole idea of forward guidance is. And this is, don't mean to take us off this path, but they've tried to influence long-term rates with forward guidance and by buying different parts of the yield curve.
In these zero interest rate situations.
But
in
you are
particular.
absolutely, under the old system, they certainly could hold interest rates lower than they should, and they did. In fact, they helped cause the housing bubble. The interesting thing is, in that system, at least there was some market input. Federal funds trading desk is giving a signal. Under this current system, there is no market input. Right. And as a result, I think it's even moving back a step to that scarce reserve system would be a step forward, and then we can talk about moving
Dr. Cohen,
forward.
are you familiar with the Austrian understanding of the business cycle and explanation of the business cycle, and do you accept the idea?
A little bit, I'm not.
The ideas were basically that inflation and the effects of expanding credit hit different segments of the economy at different times. They lead to misinformation. They lead to a theory that you believe you're better off than you actually are. And so capital goods makes a decision, consumers make a decision. There's a time lag between these two, and by the time it catches up and the consumers say, oh gosh, we have 3 times as much money, it's worth a third less, the capital goods people are still making stuff, and then that differential and that separation is what causes it. It isn't like on TV it's presented as, well, gosh darn it, we just don't know what causes inflation. And we don't know what causes it. It's just a mystery what causes the business cycle. And I think it was actually explained pretty well by the Austrians.
Yeah, so I think I agree that expectations are very important for how people spend, and they form their expectations by looking around them. I also agree that people tend to get very optimistic in the up parts of the cycle and very pessimistic in the down parts, and that's consistent with the story you're
The
telling.
key factor that counteracts either irrational exuberance or any of that is the interest rate. So if the interest rate doesn't rise, it's the one price that is universally throughout the economy. It's the one thing that will slow an economy down that is going too rapid. And by too rapid, I don't know that. It just, there is a point at which the economy is growing so rapidly that you feel that you're in a bubble. It's not my job to figure that out or to tell the economy to stop. But as interest rates rise, less things will be financed. There will be less
But
loans.
there was very little inflation in 2006 and 2007. So I was I was voting on interest rates in 2006 and 2007. And we did raise rates for a while, up to around 5%, I think. So not 2%, but more like 5%. So their real rates were positive. There is an argument, and I've had this discussion with John Taylor, for example, that the Fed should have raised rates a little more because the inflation threat was higher. I think the problem was regulation. There was too much deregulation. There was too much reliance on the private sector to make decisions, and without constraint and without recognizing the knock-on effects, the externalities, economists call them, of the decisions they were making. And risk built up in this euphoria, to your point about cycles. And then when it collapsed, it really collapsed. And you're right, it was a loss of confidence that really caused the financial crisis in 2008. The
Thank you.
losses were there.
I just have one question.